In this video, we're going to look at Alex Hormozi, what he says about whole life insurance agents, and the industry. We're looking at two clips that he did, one on YouTube where he talked about the lessons. He actually has 2 minutes in that long video that we're going to pull from that talks about life insurance, what to be careful of, and I give a summary of his key takeaways from life insurance there. Then we're going to look at Instagram and a reel that he posted and then deleted, but we have that footage. And your initial reaction to be is like, Caleb, why are you showing this? Because Alex can be really, really critical. And the point is, I think he has really, really good points. I want to share them with you, create a little bit of color commentary, and then hear from you in the comments on what your thoughts are. So without further ado, let's jump into Alex Hormozi.
This is what I have invested my money in this year. First, we have a whole life insurance policy, high cash value up front. You have to be really careful about the people that you work with this because they can totally screw you and they are incentivized to screw you. And most insurance agents will not want to hear that. But the commission structure that they have for these policies is insane. It destroys the cash value that you earn from these things. So if you decide to set up a whole cash value, whatever, insurance policy, one, go with the big four. So that's Guardian, New York Life, Northwestern Mutual, and UMass, or Mass Mutual, excuse me. So those are the big four. They've been all around for over 100 years. New York Life's been around for 183 years. They predate the tax code. The reason I did that is because it basically creates a bank account for you that you can use. You obviously pay costs in the beginning, but you can basically loan against the cash value of the insurance, and the cash flow guarantee is, it's guaranteed growth at about 4% a year. And so if you just compare that to a traditional bank account where you're losing money, this at least covers for inflation, right? And so that allows you to at least park the money in a way that's not devaluing itself. And if you do see opportunities, you can loan against it and invest in those things. So that's the first thing that we did. If you ever do one of those, you should be able to break even by year 3 to 5 at most. If it's designed properly, they'll tell you that no, that's going to sacrifice the long-term blah, blah, blah of the thing. I think that's when you compare it to the present day cash, like the value of having your money available to co-invest at the same time it's not even an argument, in my opinion. It's also how corporations and banks and Fortune 500 companies structure it. So look into Coley and Boley, which is corporate-owned life insurance and bank-owned life insurance, if you want to see how they structure it, because they know what they're doing. And so that is how we structured it.
Let me just recap what he talked about. Whole life, high cash value account. Insurance agents are incentivized to screw you, which I think at the end of this video, you'll see why he says that. Number 3, he says, go with one of the big four. I know why he's saying that. I know where he's getting that. And I think I will agree and add to that. I think the big four are great. I think there's a couple other companies that can be added to that. I think you need to look at mutual companies versus stock. I think you need to look at track record and have they been around for over 100 years? Do they have track record of paying? What are their ratings? You can look at their Comdex score and the AM Best. And it really comes down again to the structure of the policy, because again, if you have a policy that's breaking even in his words, 3 to 5 years, I would much rather have a properly structured policy with a mutual company that's been around a while that has solid ratings than going with a big four company, which again, we have access to, that is not properly structured. So again, being in the space, I understand why he says that. And we look at the big four all the time when we're working with clients and give the clients the ability to choose pros and cons on that. He talks about creating a bank account that can use to loan against. And he talks about you getting 4% a year. And I think if you look at the internal rate of return long term, that's possible, especially for someone his age. I want to note Alex is solely looking at the internal rate of return of the policy, which is fine. I think there's other benefits to life insurance that also increase the value, but he's solely looking at the rate of return, which is, again, fine, but it's something that I think you kind of sell the asset short if all you care about is the rate of return. He says he's parking his money, better rate of return than a savings account, and then he's looking for opportunities that he can use it. He's saying it should break even in 3 to 5 years, and then he's talking about Coley and Boley. What he means by that is a lot of corporations use corporate-owned life insurance for golden handcuffs and use that to incentivize their key people, and over 3,000 banks in the United States today have some of their tier 1 assets in bank-owned life insurance because of the same type of concept. And so that's what Alex said. And I think there's a lot to that. And again, I agree with the majority of things that he says. And I just wanted to color commentate a little bit of this. So this is a video that obviously when came out on Instagram, many people tagged me in it. They forwarded it to me and I watched it. And again, I did not react. I was like, yeah, I totally understand why he says this, but then he deleted this video and wrote a written response. But let's play the video first before I go into the written response.
Here's why you're probably going to get scammed into buying life insurance. Life insurance is one of the most profitable enterprises that exists. If you think about the oldest businesses that exist, they have to be the most profitable because they can weather depressions, wars, etc. And the oldest companies in America are insurance companies. They predate the tax code, which is why there are advantages to owning insurance, but they've structured it so you're not going to be the one benefiting from it. The reality is that you'll probably get scammed, you'll probably lose all your money. Most of those products, 80% of them get abandoned before they come to fruition, which means that you forfeit all of the money that you gave them. Most of it, the first year especially, is going to the sales guy who sold you. The second thing, 80% of those get forfeited before they even break even. And they know that and they factor that in to how they make money. If you want to pursue whole life insurance, honestly, the likelihood that you get scammed is just almost 100%. And I can't recommend.
And again, people are sending this to me and like, hey, what's your response? And I agree. Like literally, I've had videos on here. I am optimistic because we help people every day with this. We're like super nerds, but the more and more I see how people use life insurance and how they overpitch it, it definitely makes me more cautious. It makes me less excited. And I constantly am trying to say like when set up and used properly and trying to make videos to help people see that if you do this wrong, it does not have my endorsement. And I'm says the person that has the book, The And Asset, which I know people use to sell products that Alex is talking about. And I just have to be okay knowing that there's the good, the bad, the ugly that happens with content and even these videos. And so here is his written response. So he deleted that video a day after, and here's what he put on Instagram. I'm going to read this whole thing and I'll give an example. He said, FYI, posted a video about insurance yesterday. Important nuances were edited out. It happens when you put out 100 plus pieces of content per week. So I deleted it. For those who saw it, it didn't reflect my views on whole life, which wasn't even clarified that it was about whole life and all the ways that it's wonderful. Many whole life policies are forfeited before they come to term and make those a true waste of money. Do you know that many whole life policies, 80% of your first year goes to the salesman? Did you know that the incentive of the salesman is against the consumer? Lessons from Munger. It's hard to do the right thing when how you get paid is directly opposed to it. It's a good quote. People will make up all sorts of ways to justify it. All that to say, whole life is a great vehicle. Period. But if you sign papers as someone spew MEC limits, PUAs, premium term, death benefits at you, you likely got hosed. For my policy, the difference in commission to the agent between a well-structured policy and a standard policy would have been, drumroll please, 800 Z's. Instead, it was about $100,000. And if you didn't know that they get commissions, you probably got hosed. It's tough, period. I remember I was pitched whole life by people in a group I was in. Something felt off, so I didn't do it. Glad I didn't. Would have got hosed. Just ask whoever you're pitched what their commission structure is and how much they made on your. What I did is I used an example of one of the policies that he could potentially have. We're again speculating here, but I'm showing one policy that he has, and you'll see that it's a traditional policy, and we're showing $1 million going in, and you can see the first year cash value is 0. And this is a company that he mentioned in one of his other videos, one of the big 4, and this would have paid, around the kind of money that he says in Instagram. Okay. So you can see that the first year you put $1 million in, you have no cash value. You put $1 million in year 2 and you have $75,000 worth. And this is an extreme example. And over time you can look at this and say, this is incredible. It's over $100 million of death benefit and it breaks even and all that stuff. But Alex Hormozi understands opportunity cost and says, okay, don't just do it for some future 20 years down the road. The opportunity cost and what I could do with that money is far greater than what the projections on paper, which I agree. And so that you take the same company, this is my point that I'm making. Take the same company, you just structure it different where highly, highly reduces the cost of setting it up. And now you take $1 million, that same premium essentially, and instead of 0 in the first year, you have over $900,000. And this one, I think, breaks even in year 5. I mean, it's close to breaking even in year 4, but it officially breaks even in year 5. So this is just an example based on his Instagram message. We can speculate and say that he has a similar policy like this. And even Alex Hormozi, someone who's crushing it, understands that life insurance should play a part of his portfolio. And he doesn't look at this as an investment. He's saving. It's giving him a lot of benefits to his estate, but I'm sure he's utilizing that capital potentially to either loan against with the bank, or he's borrowing against it himself and going and directly investing in certain. After watching this video, you're like, hey, I wonder if life insurance would be a place that I would want to store and use my money, and you want to see numbers. We have this thing called the And Asset Vault down below. You can check out more information. We have a handbook, we have a masterclass, and we have some other resources that you can learn more. And if you want to talk to someone on our team and see numbers for yourself, you can check that out down below. Thank you again for all of you that watch, comment, and share our content. Take care.